In this short Killick Explains Finance video, I want to look at some top tips from one of the world's most successful investors, indeed by some measures the most successful investor over the long term, Warren Buffett. So, first of all, who is he, and then what can we learn from some of the successful investments he's made in the past? Well, he's known colloquially as the Sage of Omaha, and he's the chairman of an investment firm called Berkshire Hathaway, which appears in the press along with him pretty frequently. His annual letter to shareholders, widely circulated and published, certainly beyond the shareholder base of Berkshire Hathaway. And the reason is quite simple. Doesn't matter which way you cut it, his results are pretty impressive. Since 1964, the firm, that's Berkshire Hathaway's book value per share, if that's a yardstick you like, has risen 19.4% per year annualized. Look at it another way. If you look at sort of market capitalization, or the market value of stock, if you like, $1,000 invested in 1964 would be worth over 15 million now. So he's doing something right, or he's done something right. Now, clearly, we can't all be Warren Buffett's. All right? He had first mover advantage. He was able to buy stocks early in a way that's simply not possible necessarily to replicate now, and he's very careful not to let people know what he's up to, otherwise they'd simply copy him. So he had some advantages in the early days, which have become harder to replicate. But nonetheless, you can draw some lessons from his letters to shareholders about sound investing, value investing principles. So what are they? 6 top tips. Now, there are plenty more actually, but here are 6 of the top ones. Look for firms generating a high return on capital. Now, I deal with return on equity in another video, so this is just very much a snapshot summary, but he likes firms generating a high return on capital already. That's the return to all providers of finance, debt and equity, or return on equity, the profit return to people who supplied shares to the company or share capital to the company. And he's not interested in firms that have got potential there. He wants to see a good, steady, high return on capital employed as evidence that this is a business worth buying into, and it's already established as a business worth buying into. Number 2, avoid highly geared firms. This is a contentious point. Some people would say, that firms that carry a lot of debt relative to equity, a topic I cover in more detail in other videos, but firms that do that, cover a lot of debt, carry a lot of debt relative to equity, generate bigger and faster returns for shareholders. And that can be true in a bull market, but Warren Buffett's approach is a relatively conservative one, and he likes to avoid highly geared firms. So he's basically saying, I want a high return on capital and I want it generated with a relatively low amount of financial risk. Number 3, check cash conversion. Now, these are useful tests to know what company you're buying in what sector. Is this a company that can turn profits into cash flow? There is a little ratio, a little number you can Google, cash cover, which is the relationship between profits from the profit and loss account, operating profit if you like, and operating cash flow. And you want to see some correlation between the two. Danger signs for Warren Buffett are firms generate a lot of profit and virtually no cash flow, or where the two numbers are bobbling all over the place. Number 4, only buy simple businesses that you understand. Now, simple is an interesting idea. If you are somebody that's been working in the city for years and years and years and understands complex derivatives and hedge funds, there's no reason, according to Warren Buffett, why you couldn't go out and invest in firms engaged in those activities. But for most of us, for most people, stick to stuff that you understand and you can get your head around, because his view is that if you can't understand what a firm's up to, how it's generating profits, you're really taking a bit of a punt, frankly, without someone else helping you on whether the firm is a suitable long-term investment. All right, you might as well almost back the horses, because you probably know more about horse racing than you do the business you're looking at. So by all means, he's not saying we should all just buy widget manufacturers, but he is saying have some idea of what the firm you're investing in actually does. Have some enthusiasm for it. Seek out strong brands and pricing power. This is very important to Warren Buffett. He likes big brands with pricing power. Now, these are brands that are not going to vanish overnight. Okay, if you take the example of the razor manufacturer Gillette, for example, there's a good example of a company that he likes, he favours, or he has favoured in the past. Very strong brand name and able to protect its market. And the way they do it is quite clever. The thing that you mount the razor blades onto doesn't cost very much, but the razor blades cost a fortune, and they keep changing. So why have 2 blades when you could have 3? Why have 3 when you could have 4? They're quite clever at the way they protect their market and seem to manage to increase the price of what a lot of people would consider to be a kind of day-to-day bog standard product. Okay? Number 6, make sure management have skin in the game. Now this applies to fund managers actually as much as it does managers of businesses, but you want to see evidence that management have some form of remuneration linked to the performance of the company. So you don't want management to be completely dominated by share-based payments, because then they might just try and hike the share price short term at the expense of long-term value added. But you do want to see evidence that management do either hold a reasonable number of shares relative to their own personal wealth, and or perhaps have the ability to buy more in the future. So there you have it, 6 basic top tips from Warren Buffett, and combined he has successfully used that as a way of screening solid long-term growth potential stocks. Now while we're here, he's also famous for some wise words. I've just picked half a dozen phrases and let's have a think about what these might mean in the context of the last slide. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. Now that's heavily quoted, but his 6 tests are his way of saying buy safe, stable, cash generative companies and you're less likely to lose money, because the maths of losing money, I'm afraid, is pretty grim. What I mean by that is, if you lose 50% of the cash you start with, you need 100% gain to get back to where you were. So the maths of losses works against you, and his 6 tests are one way of avoiding companies that will lose your money quickly. Number 2, investing should be simple, but it isn't easy. In other words, the tests I mentioned on the previous slide will rule out a lot of speculative, fast-growing stocks and certain sectors too. And he's quite clear about that. He's saying that keep it simple, stick to what you understand, stick to big, powerful brands and so on. But it's not easy. You've still got to do your homework. Just carrying out those 6 tests properly would take long enough, let alone any others. No matter how great the talent or effort, some things just take time. So don't expect to get gains out of shares immediately. All right? Investing in stocks is a long-term game. Time in the market is more important than trying to time the market. Only when the tide goes out do you discover who's been swimming naked. Number 5, and the final one, these two are linked in a way: be fearful when others are greedy, and greedy when others are fearful. So his point here, he's making several points here, but he likes firms that can manage in a downturn as well as an upswing. It's all very well buying when the market's rising, but to some extent that, that tide will float all boats. Who are the firms and managers and brands that can cope when the market dips as well as rises? Okay, the stock market tends to rise over time, but it does sometimes take some big dips, and history can tell you how successfully a firm rode out those dips. And then, this is where investing should be simple, but it isn't easy. Be ready to be greedy when others are fearful, buy in a trough if you know what you're buying, and also the exact opposite. Okay, so be prepared to stick to your investing plan even in the face of adverse market conditions. Easier said than done, actually. That was quite a lot of ground covered. Any questions, please send them to me at the usual place.